Let's bring in longtime retail executive Gerald Storch of Storch Advisors to discuss Nike and more. He is known for running Toys R Us in Hudson's Bay. Jerry, great to have you with us.
My pleasure.
What's your take on a stock like Nike, as we enter sort of a period where there are question marks around the consumer's ability to keep spending?
Hey, look, unbelievable brand, fantastic future. They make their own product. That's the ideal, being a retailer. But we're entering a time which, in my opinion, is going to be quite challenging for consumers. We continue to see persistent inflation. Consumer balance sheets are definitely stressed. We don't know what's going to happen tomorrow with student loans, but, that's not good either. So generally speaking, I'm not sold that the consumer is healthy, and I'm concerned about what things are going to look like as we get closer to Christmas.
How about the argument that there are some consumers who are not as impacted and that they will keep spending? Does Nike not fall into that category of the kind of retailer where they will keep spending? Does it have to be, higher up the food chain, so to speak?
I don't think there's anywhere that's totally safe. There's no doubt that a strong brand like Nike is in a much better position than a weaker brand. That being said, though, consumers are simply spending less on things, on goods. And when you inflation adjust retail sales, it's been 8 or 9 straight months that sales have been negative. So basically buying less goods than consumers have in the past. We all say, OK, they've migrated to services. And there's no doubt the airlines are strong. You heard that from Delta. Accommodations are strong. But even that is slowing down on a year-over-year basis. And most of the so-called increase in services spending is actually being spent on health care and rent, on housing, areas where consumers have to pay for products that have gone up in price, as well as, of course, there's a pandemic rebound on the healthcare side.
Hey, it's Karen. Thanks for being on. I was surprised to read that 25 to 49-year-olds have a big portion of student debt. I was actually thinking it would be lower. So that was interesting as I'm trying to look somewhere where to hide. I've been hiding some in very, very high-end retail, like a Louis Vuitton or a Kering. Again, I wonder what you think of that.
Well, high-end retailing has also been stressed, particularly in the United States. Some of that is because a big part of the growth was taking place in the aspirational segment. These are younger than your traditional, well-heeled, older people who are spending in their retirement years on very expensive goods. These are people who might buy, for example, a pair of very expensive Gucci sneakers, if you want to think about Nike sneakers and Gucci sneakers, for $800 or $1,000, but not do a lot of that. So we've seen that fall off a cliff in recent months, as they're just not spending that kind of money. And even though it's true, of course, the 80-20 rule, that most of the money in luxury is spent by the richest people, it doesn't help when you lose the 20. So we see that taking place. By and large, the other part of the retail luxury market, the other high-end customers, will keep spending as long as the stock market does well, because that's the highest correlation there is anywhere in retailing between stock market performance and luxury spending. But if the stock market stalls out, I would expect that to stall out as well.
Jerry, we haven't even seen the economy take that much of a dip so far, in terms of being in a recession, and yet we're seeing high levels of shrink to the point where retailers are citing it as an issue on their conference calls. How do you expect that sort of problem to shape up as we go into more of the downturn mode, when people are actually losing their jobs, unemployment ticks higher, and the consumer's even under more pressure than he or she is right now?
Well, shrink has been growing rapidly, double digits over the last several years during the pandemic and in recent years, as well. So it's probably closing in on $100 billion in terms of a tax on the retail system. Like, retailers needed another headache in addition to supply chain increases, wage increases, raw materials cost increases. Now we have growing theft taking place. But most of that is organized crime. You have to keep that in mind. And why has organized crime increased so much? Well, it's easier to fence the goods. The rise of online marketplaces has certainly fueled the ability to liquidate the products very rapidly. And additionally, the laws have changed, making the risk that if you get caught, it's much less likely you're going to serve time. So the risk-benefit has gotten, more in favor of organized crime, and they've been doing more stealing, both earlier in the supply chain, off trucks at the port, off trains, out of warehouses, and just slash and grab in stores. It always took place in retail before, but it's definitely increased dramatically. And, there's a new law that went into place just this week, the Inform Act, that's supposed to make it more transparent on these online marketplaces, who's selling what. So it's not supposed to be as easy to sell those goods. But I have a lot of confidence in the ability of the crooks to adapt, just like they have in cybercrime. And they've been moving off of the more known online marketplaces like eBay or Amazon or wherever onto P2P exchanges, where the so-called dark web, where they can sell these goods and continue to thrive. So I think it's going to keep going, unfortunately, without a lot of effort.